we are in a new bull market. And I know that's hard for some people to believe, but if you go back until October of last year to where we are this week, we're up nearly 24% from that bottom, and that is a heck of a rally, Derek.
It certainly is. I mean, clearly Wall Street was poorly positioned for this bounce. The economy's been more resilient than even the Fed thought, and corporate earnings continue to deliver. In fact, we're actually looking for second quarter earnings to be actually flat if you exclude energy.
And you look at across the sectors, that things that are doing well, there's no doubt that the big tech stocks have really pulled us along, representing a big part of the game, but that story is starting to expand.
Well, it is. I mean, we saw a really sharp rally in small caps last week. That petered out a little bit this week, but the Magnificent Seven continue to carry the day. That's the new buzzword that Kramer has adopted, so I may as well borrow that. And that's Apple, Microsoft, Amazon, Nvidia, Tesla, and Meta.
And you look at those big tech stocks, and will the story continue? And will it continue as AI becomes more of a story? You really can't get away from it. For everywhere we look, we're talking more about that conversation, but it really is beginning to expand, and it's beginning to expand because you look at where we were and what the expectations are. We saw the Fed meet this week, and they did what we expected them to do, Derek, which is to pause. However, we do not know what they're going to do next time around.
Well, we don't. And the other thing that surprised the markets, and frankly surprised me by the market's reaction, was that they actually upwardly revised the dot plots. In other words, their expectations for where rates are going in the future. In fact, 4 of the Fed members were actually calling for 3 more rate hikes. So clearly they're going to be data dependent. A lot's going to depend on what the price of oil does and gasoline. And then we'll see. But by and large, people are taking this as a feeling that the Fed is close to done. And that's also helped the multiples on those Magnificent Seven stocks.
And you look at this really, Derek, and it really gives you a bit to pause on, because you look at the story that we have talked about for the last year. No doubt we pounded inflation into the ground and certainly talked about the Federal Reserve and what they've done, potential recession, the debt ceiling conversation. All of this made the market climb a wall of worry, but that's exactly what it did. And you look at the consumer sentiment, and that's really something we're watching closely now.
Right. We saw the consumer sentiment saw a sharp rise in June of 8%, the highest point it's been in 4 months. It's still at a very depressed level relative to history, but certainly going in the right direction. And of course, the positive wealth effects of a rising stock market and a strong housing market certainly causes people to feel a little bit better about the future.
And of course, jobs. We saw a jobs report 29 straight months now of job gains. And if you really take that report apart, it is interesting because if you look at the folks that are 25 to 54, 83% of them are working. So, we talk about labor participation and that rate being down. There's no doubt that people retired or they changed jobs or they're staying at home, whatever it is. But those who are in working age condition continue to work. And that, of course, is driving a big part of the economy because people are working, and that drives consumer sentiment.
Right. And I do want to give an update on that fear and greed index that we talk about a lot. This week it hit a new high for the year at 83, which is a very high, elevated number. In other words, there's a lot of optimism out there, extreme greed, if you will. But the underpinnings, the technical underpinnings in particular, are getting more and more solid. We're above the 200-day moving average. We're above the 50-day moving average. The percent of stocks above the 50 and 200 is increasing, as you mentioned, in terms of breadth. So the technical prospects for the market look pretty good. Of course, we could have a correction at any time, but it's certainly a much different story than it was last year.
And let's talk about being a contrarian, because you and I often talk about this. When everyone was calling for a recession, we said there's a possibility that the Fed might get it right and that we could get a soft landing. But here we are rallying from 23, 24% from where we are. But, folks, it is not unlikely that we still could go back to where we were sometime between now and the end of the year.
Right. I mean, the prospects for a recession have certainly dimmed in 2023, but there are still many calling for a recession in 2024. And they talk about banks being less willing to lend, the persistent inversion of the yield curve. They talk about valuations. We're now trading almost 20 times forward earnings. So, you have to have a balanced approach, which is what I think is one of the strengths of our investment committee. We have people have all sorts of different opinions. We had some who thought we'd have a hard landing. We had some that thought we'd have a soft landing. We thought that some thought that we wouldn't have a negative GDP print at all. So, there are a variety of opinions. But through all of that conversation, I think it clarifies our direction and sets us apart from our competitors.
And as you go through this process, folks, there's no really one right answer. which is the reason why you have to go through this and have this diversified portfolio that we talk about. But where it's diversified and how it's diversified can change significantly on who you talk to. That is the reason why you have to go through the process, get to your goals and your personal circumstances. That is so important.